Welcome to the Tech Today podcast with your host, John Mayetta, back after an extended power outage. I haven't yet written the title for today's podcast, but it will probably be something along the lines of Fed Chairman Jerome Powell is Arthur Burns 2.0, not Paul Volcker 2.0. Arthur Burns, of course, was the Federal Reserve Chairman back in the late 70s when the United States had record inflation. Burns was guilty of pulling back on the Fed's tightening effort too soon and allowed inflation to reaccelerate. Volcker came in after the fact and was able to tame inflation by increasing the Fed funds rate to record levels. And so if you look at what Powell and company have done, so they oversaw massive inflation, and they're not 100% guilty of creating the inflation. There's a fiscal responsibility here. So in addition to the Fed having its monetary policy, it really enables fiscal policy. And the way it does that is on the fiscal side always spends well above its means, meaning it spends money that it doesn't have. And the way it does that is it issues treasury debt to fill in the gaps, the fiscal gaps. And much of that treasury debt is not purchased by private companies or sovereign nations. It's purchased by the Federal Reserve. And the way the Fed does that is it prints money out of thin air and uses that money to subsidize Treasury's debt, thereby increasing the money supply, devaluing the dollar. The dollar's already lost 99% of its value versus gold since President Nixon took the United States off of the gold standard on August 15th, 1971. And that last percent of value that the dollar has versus gold is being whittled away little by little as we continue to print. So if you think back to 2020 and we had this massive fiscal stimulus, well, the Fed subsidized that fiscal spending. In addition, it created its own one-off facilities, non-recourse loans that were made to many companies that didn't need them, private equity firms, venture firms, right? All sorts of folks that got money, Oppenheimer Capital. I mean, the list goes on and on. We actually published the list back in 2020. In addition to all of those one-off credit facilities, Apple, by the way, the Fed participated in Apple's debt offering as if Apple needed the cash back in 2020. In addition to all those one-off facilities, the Fed, of course, oversaw a record quantitative easing effort. And by the way, quantitative easing, which was initiated back in 2009 during the bank bailouts, that was supposed to be a one-off, a temporary one-off for X number of months. And of course, there is nothing as permanent as a temporary government program. And fast forward to 2020, 2021, 2022, QE was well and alive. During the COVID period, the Fed, right up until May of 2022, the Fed was buying 120 billion of treasuries and mortgage backs each month, 90 billion of treasuries. So just record easing caused this massive inflation under Jerome Powell. Had a heavy hand in the inflation. Powell then ratchets the Fed funds rate up north of 5%, which did it fairly quickly. I don't consider it to be a massive tightening. I think it's barely a tightening effort. If you want to say it was barely a tightening effort, I won't push back too hard on you. I probably wouldn't push back at all. If you want to say it was a neutral effort, that's fine. Slightly dovish, that's fine. Because I believe real price increases, not CPI, but what's going on in the real world, those price increases that sort of started the second half of 2020 are much higher than CPI. So of course, CPI today sits at 4%. The real number is some number north of that. It is probably in line with Fed funds, slightly higher. So we don't even have sort of real interest rates at the Fed funds level, or just barely, or we're at neutral, whatever. But it's you can't say conditions, or at least I'm not going to say the conditions are tight, the monetary conditions. Powell got us there. And for the last several months, the Fed has paused in terms of where Fed funds sits. On the other side of the ledger, so you have Fed funds on one side, if you think about monetary policy, the Fed's levers for tightening or loosening monetary policy. Then on the other side, you have quantitative tightening or quantitative easing. We've been tightening since the second quarter of 2022. And if you look at QT, and I don't have the number in front of me, but we publish it each week, but the QT effort is a lot more modest than the QE effort when the Fed was buying 120 billion of bonds a month. Now they're sort of letting, I'd say, and this is just a guess, we'll publish the numbers on Thursday after the close when they come out, but I want to say that the Fed is tightening to the tune of probably 50 billion-ish of treasuries a month, maybe some number less. So call it approximately, the tightening effort on the treasury side is about half of what the easing effort was on the treasury side. So QT is quite a bit more modest than QE was. So the Fed's had this modest tightening program. Inflation has slowed, but that's not a Fed win, in my view, given the massive price increases that we had in 2021 and 2022, where CPI, I think the number is roughly 40% over those 2 years. So price increases grew by 40% plus or minus a few percentage points as measured by CPI. And now prices are continuing to increase, albeit at a slower rate. So how is that a win? And even if the Fed were to get CPI down to 2%, which is the target, how's that a win? When the dollar only has 1% of its value remaining versus gold. And you're telling the American people that every year we're going to dilute the value of the dollar by 2%, because that's what you're saying when you say you have 2% CPI as your target. How is that a win if the value of the dollar is going to erode by roughly 2% a year each year in perpetuity, given that the value of the dollar has already been eroded by 99% when it's measured versus gold? That's not a win. There's nothing that the Fed can do to win the game, to win the day, in my view, because the damage was already done in terms of those massive price increases in 2021 and 2022. To help rectify the problem, what the Fed could do is allow the recession that needs to happen to happen so that we can have price deflation. So, which means prices would decrease in absolute dollar terms. And you could eliminate some of those price increases that occurred in 2021 and 2022, particularly with regard to everyday items, such as food. Get the price of food down. Food at home, food away from home, which are the two terms used in the CPI calculation for measuring food prices. So price deflation would be a win. Of course, it would be painful, unfortunately, because to get prices to decrease in our economy, which is consumer-driven, you have to have less consumer spending, which unfortunately means job losses. And Powell's on record saying that doesn't want to do that, thinks they could get inflation under control without job losses. But unfortunately, Americans have already suffered a massive tax that we as Americans don't get to vote on. That, of course, is the inflation tax. So we've already felt the pain. And trying to call where this economy is going to go in the next year is difficult, because the great unknown, the Fed's an unknown for sure in terms of how they'll pull back on rates in QT, although I have some thoughts on that. But the great unknown is the fiscal side. So I feel like it's 50-50 as to whether the Biden administration tries to push through another fiscal stimulus program in advance of the November elections. And I'm not convinced that the GOP House will try to push back on such an effort, because I feel like the GOP would rather go along to get along for fear of being viewed as the bad guys, rather than have a conversation with the American people as to why a round of stimulus is not a good idea, which is because it would cause more inflation, just like it did back in 2020 when the Trump administration and the Biden administration's mailed checks to people. But rather than have that conversation, I think the GOP will go along to get along, and that they will back a stimulus effort by the Biden administration. So I feel like that's the great unknown. I feel like if that is to happen, Team Biden would try to push that through in Q2 so that people would have it to spend for the summer. Wouldn't want to do it too soon. Should people forget about it at the voting booth? Wouldn't want to do it right up against the election. So I think we could see something like that in May or June. If we don't have stimulus, then I think the economy for sure rolls over. I believe we've been in a mild recession since 2022. If you look at nominal GDP and back out real price increases, not the GDP deflator that the government uses to calculate real GDP, which is sort of a proxy for CPI. But if you back out real world price increases, I believe GDP has been negative or operating at zero, depending on the quarter, since 2022. And that the economy is going to take another turn south in 2024 as lingering stimulus programs wrapped up back in Q3. We had, for example, the employee retention credit that sort of bled out in August, September. Student loan reprieve, that goes away. So those income assistance programs are gone that were part of the initial CARES Act back in 2020. And so now the economy has to sort of push through on its own, as powered primarily by the consumer. The consumer obviously is weakening given elevated prices. And so I think we're going to have, as I've talked about in previous podcasts, sort of muted earnings when companies start to report earnings in the second half of January and the first half of February. Conservative guidance. Interest rates are still high, so that's going to eat into profits. I don't see a profit acceleration, as some Wall Street commentators have talked about, in 2024. And as the consumer pulls back, all sorts of companies are going to feel it, both on the consumer side and the enterprise side. I've talked about that before. So you have sort of this weakening backdrop. And I think it'll get worse. And I think that will cause some price deflation that the economy desperately needs. But when Powell comes out with his dovish call last week at the FOMC meeting and causes yields to pull back even more, what are they at, 3.9% now? They're down another 7% versus the 4.2 that they were at 4 or 5 days ago. So he's caused financial conditions to loosen even more, which is going to open the window for price inflation. Right? We could see price inflation accelerate in the next month or the month after, at a time when the consumer is already pulling back, which is the stagflation that I talked about a couple of quarters ago, where you have muted spending, muted growth, or negative. We have a negative GDP quarter, yet prices still remain elevated. And so Powell could be setting up a period where the Fed's going to have to go back in and lift Fed funds. Not the way I would do it. I would accelerate QT, but they like to pull the Fed funds lever more than they do the QT lever. But the Fed may have to jump back into this market if prices start to accelerate, because Powell got too dovish too soon, just like Arthur Burns did back in the 1970s. And history looks like it very well may repeat itself. That's all for now. See you next time.